Well, the Bank of Canada did it again, and you've probably seen all the content that you need to see in video format, including our own YouTube video, as well as a lot of other posts at this point. It's been a few days, and it's time for us to do a deep dive and a digest into what this means for, well, the real estate market, what's likely to come going forward, and who else this impacts. We're also going to talk about, economically speaking, what else is going on and how those indicators actually impact you. There's so much news going on right now in the real estate market, and we are focused on improving your knowledge so you can make better financial decisions. If you haven't already done so, make sure to rate us and review us on iTunes and Spotify. We really appreciate that, and share this out with someone else who is loving this show. We're going to get back into giving away a gift for reviews. So if you leave us a 5-star review, send us a snapshot over to our YVR REMO. If you haven't already done so, make sure to send us a copy of your 5-star review over to our Instagram account at the YVR REMO Show, so we can send you a beautiful Thrive mug with some delicious coffee. It'll keep you going for weeks and weeks and weeks. So again, can't wait to see you guys on the other side. Enjoy the show, and we'll talk to you soon. What's up, guys? You are listening to the YVR REMO Show, where we talk all things Vancouver real estate and mortgages, take boring topics and make them interesting. Make sure to stay tuned to listen to everything you need to know how to put cash back in your pocket, create wealth in real estate, and simplify the complicated. Okay, so another time that we're sitting here doing a roundtable conversation about the Bank of Canada's changes and what they're doing and what they've done. At this point and this time, I can't say that we're shocked or surprised, but almost dumbfounded that the Bank of Canada decided to do another rate increase. And there's no doubt at this point right now that the Bank of Canada is on an absolute mission to try and reverse what they did over the course of a year to a year and a half. And everybody can question whether or not it works or whether or not it's making sense or anything of that nature. But the reality is they're doing it. They're raising rates, and they're impacting those people who have variable rate mortgages. They're impacting those people who have lines of credit. They're impacting pretty much every homeowner right now, because they're also impacting qualification to buy a home. So this particular rate increase, which if you didn't already see it, was a 0.75%, so that's 0.75% increase to the Bank of Canada's overnight rate, which today stands at 3.25%, previously 2.5%. And for reference, at the start of the year, in the calendar year 2022, when we turned the tide, we were at 0.25%. So it's a 0.25%, which means between January 1st, 2022 to today, we've officially seen the Bank of Canada increase rates by 3%. That was a whopper. What are your thoughts, guys?
Yeah, it was shocking, and it wasn't. We were prepared for an increase, and I think the Bank of Canada has done a really good job at that, to just be transparent and inform the public and us in the industry that these rate increases were going to come. And so we were expecting it. We've been saying this for quite some time. The government has also said they want to see 4 consecutive months of inflation data being down. So started to see some improvement from the inflation that we're dealing with right now. The target was somewhere between 2% and 4% for inflation. I think we're at 7.1 for July, 7.3 or something like that. So again, there's a lot of work to do there. So I don't think it was a surprise from a perspective of like it was coming. I think the surprise to all of us was just the amount. But the other thing they have said is that their target was to get into that 3.25% range on the overnight rate, and that's where they are today. So I think a lot of people maybe got a little too excited from the fact that thinking that this could be the very last increase. I would probably include myself in that. I was of the mindset that this is probably going to be the last one. And we've seen some experts come out with opinions that support that this could very well be the last increase. But we've also seen some experts come out that we really trust suggest that this probably isn't the last one. There probably is one more, and it may take a little bit longer than we expected to start seeing rates come down.
Based on the fact that they need to see 4, or they want to see 4 consecutive months of deflation, we're not actually going to have that data until mid-November for the month of October. So the next Bank of Canada meeting is October 25th. So knowing that our government, the Bank of Canada, doesn't have the data to make an adjustment going into that meeting, I would strongly believe that there is going to be a rate hike. And again, there's tons of different opinions out there, but the way that our government's been, and they've been very bullish on this, which again, I think a lot of people are sitting back going like, this is insane. They're going to push people out of their homes. They're making it unaffordable. But there's another kind of arm to this where if they weren't going as aggressive as they are, there's a chance that a very good chance that inflation gets completely out of control. And we're talking 1980s mass interest rates, like awful financial crisis. So I'm for what they're doing. It sucks. Nobody wants to pay a higher rate. No one wants to pay higher payments if you're an adjustable mortgage, but it's happening. But if we can get this under control quicker, in my opinion, it's a better outcome for Canada as a whole, as well as homeowners, right? The market will come back quicker if we can get a handle on this sooner rather than later.
For the record, interest rates, just to kind of throw some stats out there, some things that we should know. So there were a lot of our clients who are boomers or their parents who are boomers saying it's going to be like the 80s again. And it's actually kind of funny because, well, it's funny and it's not. It's not funny that it's happening to people, but it's actually kind of interesting and funny that this is actually the highest as a percentage rate increase that we've seen since the 80s based on where they started. So they started obviously in the the quarter, and then we've gone up to such a high percentage in a short order that, of course, it's referencing the 80s from that perspective, and it's the first time we've seen the 300 bips in a short period of time since the 90s. So they're definitely going up quickly. Referencing that, Derek, like yes, they should have gone up. Perhaps if they started this much earlier, we've already discussed this quite a few times, then we probably wouldn't be seeing these massive increases like this right now. We would be more like minor adjustments. And to your point, the suggestion is that moving forward, we likely will see quarter point, maybe half point, but not 3/4 or 1. So we're not going to see those jumbo rate hikes. Some real quick context, because we kind of glossed over this really quickly, and then Dean, I'm going to get to your point there as well, is that I think people should know the numbers. Really important for someone to know that they have a variable rate mortgage, who you likely haven't received a letter in the mail yet, but your next mortgage payment, if you're on an adjustable payment mortgage, will be about $39 per 100 grand. So $39 per every 100 grand that you borrow, more than it was previously. So for those keeping stock, we've heard nonstop news, nonstop reports about these triggers. We got trigger rates, we got trigger points, and it can be often confusing. And today's episode is not really about trigger rates and points. We've done that before, but just to cut straight to the point right now, we are getting close for some folks, and some folks have hit what they call their trigger point, which is the point at which you are no longer paying down your mortgage and you could be going into reverse, which essentially means now you're eating against the equity of your particular property. We have heard some clients who have decided to call into the bank, and the bank has actually asked them to increase their payments to make sure that they are paying off some of the principal. So those folks will be somewhat impacted. Although to be clear, their payment increases would be nowhere near as high as someone who is an adjustable rate, who's still paying down the mortgage the same as they would have been before.
This is a tough topic to dive too deep into, in my opinion, just because there are a lot. We've had so many different discussions around this with banks and institutions we work closely with, and even a lot of the members that are working and advising in these institutions don't really know how this functions, which again, there needs to be a lot more work done in our industry to really advise and educate their own staff on these types of things. But like I try to just really look at this in the simplest form, and the intention of a trigger rate or trigger point is to ultimately ensure you're continuing to pay your principal down, and to just be ahead of it. And the advice that we've given many times before is always just trying to be ahead of it by increasing your payment before it actually needs to be increased. We talk about this a lot when it comes to, whether it's an adjustable rate mortgage or, variable static payment. We always want to get ahead of these items. And we've always talked that this strategy of increasing your payment be ahead of time is just going to get your principal pay down, at a better point. And that is the intention of this trigger, is to just ensure you're staying on track with principal pay down and your whole entire payment isn't interest. Like that is the main goal here, right?
There's always two ways to look at it. Like from an affordability standpoint, obviously no one wants their payments to go up, but like we got to think big picture here. What if these rates stay this high for longer than anyone wants? So you really want to pay zero principal on your mortgage for whatever that duration of time is? So this trigger rate's been looked at as like this mass negative thing. It's not a terrible thing. Like, you should probably try to stay on par with your principal pay down at least a little bit. Something interesting that we've seen come out, because again, I think that a lot of the people that even work at the banks, like a lot of them weren't around in the 80s, and we haven't seen this a lot previously. This is, a relatively new piece. And to actually there's been talks of trigger rates, but now actually hitting them. It's funny, a lot of the people that we talk to at the banks are not even 100% sure of their policies yet or how it's going to work. And, we're seeing some institutions that are saying, every time you hit 100% interest, no principal, we're going to bump your payment by $50 just to keep $50 of principal pay down. Other lenders are saying, we're going to automatically bump it up so that you're back on track with amortization. But there's a conversation you can have. If that's unaffordable, we can work with you. Right. So, and then the other side of this is like, we're talking banks here. There's millions of customers with these mortgages, and they now have to take the time to, number one, find them all, call them all, get a hold of them, and process these. Like, there's only so many people that work at the banks, right? So I had a client call me last week, and she actually hit her trigger rate about a month and a half ago, and she's heard nothing from the bank, and she was just trying to figure out what her next steps are. So
I think the key to these, to what Derek just said there is, a lot of things in the banking system are automated. Like a lot of what they do, how they process their mortgage, like as an example, adjustable rate mortgage, rate goes up, it's automatic. All these payments are going up. So they're, to your point of servicing millions and millions of customers, this isn't a standard item that we've seen. Like, to your point, this is going back to the 80s. A lot of these, employees weren't even born, let alone working at the institution. And so there just isn't an automated process for them to just say, hey, all these mortgages hit their trigger rate, here's what's going to happen. It is a one-on-one case in a lot of times, and working with clients. And it's just, again, now we're talking significant manual labor for these banks.
It's funny because we got an email recently about Rocket Mortgage entering Canada, and a lot of companies, I mean, this is nothing new. There have been years of online companies trying to basically originate online mortgages, and more companies investing into online mortgages with new companies coming out. And a lot of them are failing over and over and over again, because the reality is, I think most people, especially those listening to our podcast, value advice of an educated professional and still want to talk to a professional. Sure, you want to do your mortgage online, you want to correspond via email or text, and you want to upload your documentation instead of going to a bank. But I mean, let's be honest here. At the end of the day, you still want to talk to a human who can advise based on a personal situation. And these online companies just can't do that. And that's really what banks are right now more than ever. They're not originating mortgages or advising people on mortgages. They're basically just, here you go. We're essentially at this point right now giving you McDonald's. Do you want fries with that? And they're not really following up with people or educating them, providing an educated, understanding of what's going on. So let's kind of push forward here and talk a little bit about some opinions. Obviously, Derek, you mentioned rates rising, perhaps still going forward. We've seen feedback, the opposite of that rates may not rise. And interestingly enough, just kind of looking at the market, what's happened, we've already seen the median interest or the median price point in some of the major cities go down pretty substantially. I think in Vancouver, we're down around 18% for single family homes in the greater Vancouver and Fraser Valley. And some markets hit worse than others. Some areas have held pretty well, like condos seem to be holding up pretty well in certain areas like Vancouver, but not so much in the valley. Like, for example, Chilliwack. In Alberta, we just had, actually we're future casting here, but we have Zach Turley, who's going to come on the podcast, and he talked about Alberta having a slight discount in certain areas, but not quite as heavy as others. And Toronto was really interesting because right before this rate hike, they were actually rising back up. So interesting to see what happens here with real estate prices, but there's no doubt that this is going to have some impact on prices, because you're actually qualifying for less today at a maximum than you did before this rate hike. And the example of that would have been about 8 to 10% less. So for every $100,000 that you qualified for, you're qualifying for about $8,000 to $10,000 less than you did before. So there's no doubt that does have an impact on the value of price points. Any thoughts on where price points go and what's going on there, guys?
Especially where we live, right? Like, we saw a rapid uptick, and we've seen a rapid kind of fall, I guess you could say. But I saw an interesting article earlier today. It was actually a good note. Someone that has been trying to get into the detached home market, and they need to have 20% down because every single detached home is over $1 million where we live, and it has been for quite a while. Those people there's now a bit of an opening. As much as it's harder to qualify for that mortgage, you can buy a detached home for $950, $999. You can buy up to $1 million with less than 20% down. So if your down payment was your restricting factor of getting you into a detached home, that market has now opened up for certain people. I mean, I have clients looking at detached homes in Mission for $650,000. Like, that was not a thing a year ago, right? So there's good and bad to everything. I think the first time buyers are the people that can really take advantage of this market. If you're in the market, you're selling and buying, it doesn't matter if the market's doing really well or if it's really bad, right? Like, it's all relevant in that market. But upsizers, again, we've talked about this before. You know, we've seen a lot of people going from condos and townhouses into detached. So again, I just think that detached market's opened up below $1 million, and there's definitely opportunity there for people that didn't have the cash prior.
Great point about the down payment piece. There's no doubt that that has opened up a lot of opportunities from that perspective. As much as qualification has declined in some situations, cash available makes a huge difference, as you mentioned.
Just to further that point on the single family homes coming below $1 million in a lot of areas where we live, obviously creating a huge amount of opportunity from a down payment perspective. Really mostly just looking at that minimum down payment and being in that CMHC window, right? That's where it's just such a big game changer. We're talking like $100,000 difference in minimum down payment. Like, that is super, super significant, and don't want to oversight that. But also the rental rates. I've seen rental rates have not been impacted at all. So when we're looking at these single family homes under $1 million with a basement suite, rent rates are still the same. Like, these are really becoming like real opportunities for people, and they weren't just a month ago.
So to be clear, you're talking about from an investment perspective.
No, actually a basement suite. Like, so you're coming in with your minimum down payment, looking for a home as a basement suite to actually help you qualify, right? So that home is now below $1 million, works with your down payment. There's a basement suite to get some generated rental income and help you qualify to actually buy these homes, where, you know, just a month ago you couldn't find one for under 1.1 million.
Yeah, well, good point. Good point. So it's not that your overall cost of living is dramatically less; it's that you can get into the market, and you now have a mortgage helper, so to speak. Whereas we did not have that previously. So that make a huge difference on someone's qualification. Love to hear that. That's a great point. I appreciate it. Never thought about it from that angle. Well, let's talk a little bit about kind of circling forward here. Looking at the most recent article, so Derek, you mentioned economic data, economic reports. We're likely looking at potential rate increases, like 1/4 or 0.5% possibly. But we just got this follow-up email and report, I should say, from September 9th, which is Friday, which was 2 days after the Bank of Canada raised rates, which actually was, well, I guess if you want rates not to go up so much, good sign. Talking about employment maybe slowing down, or perhaps unemployment increasing. What are your thoughts on that?
That's what we want to see. We from somebody that wants to, you know, keep rates down and not see further increases. I mean, that's exactly what we want to see. Of course, that hurts to see if you're in one of those industries that's been impacted. I think construction was one of the categories, which was surprising to me. But you know, there you go. Like, those are numbers that you want to see. Inflation data needs to come down. You know, less jobs available is going to bring inflation down. That's just how it works. I mean, it's really unfortunate to, you know, like, to be dealing with that again, if that's your industry, but we need to see some correction here. And that's one of the items we need to see.
Interesting thought as to home price values, just in general, kind of circle back and bring this full circle here, that first of all, there's always a bottom to real estate prices just in general. So if we've seen prices come down from the peak is where they were. And for those listening, remember that whenever the news is speaking about price declines, it's always from the peak. So the peak could have been in February, the highest priced property. It's not based on a year over year. If you look over year over year, it's not as dramatic, nor is it even bad, because typically if you looked at Vancouver 1 year ago, like 1 year from today, we're actually still up based on the most recent stats, 8% almost. And so from that context and from that perspective, you ask yourself the question, if you bought a home a year ago, would you be happy if your home value was up 7 or 8%? I imagine you'd probably say yes. If that was the case, then you're probably not feeling so upset. Whereas if you're reading the news that says home values are going to be down 22% or 23%, you're probably pretty bummed out at this point right now. So circling back to that, you know, remember this if you're a listener of the show, whether you're a homeowner or you're a potential investor. First things first, there's always going to be a bottom, and I think that this Bank of Canada increases probably further push us down a little bit. But how far down is the bottom, and what does that look like? before you start shopping. Dean just mentioned that you can buy a home for under $1 million, a detached property in a location that was almost impossible for the past 2 years. And so, what does that look like when things turn around again? And at what point does that happen? If you're someone who's kind of waiting on the sidelines and not really sure, you should probably be considering that thought process, because we're getting down to the point where if you had asked someone again 6 to 8 months ago, would you have bought if the price was here? They would have absolutely jumped out and done that.
Yeah, and I think the problem with like finding the bottom or waiting for the bottom is like when the three of us know it's the bottom, it's no longer the bottom and it's too late because everyone's going to be rushing in. There's going to be one positive article on the news and everyone's going to be rushing in to buy. I believe, like, how many people have we pre-approved in the last 2-3 months that are just getting their ducks in a row, right? Like they're not going out there after they get pre-approved and writing it off for the next day. Everyone's just waiting, watching, understanding the markets, right? And I think that it's come down so much already that, I mean, you got to be buying for a long-term investment, but it's come down so much already that I think buying anytime in the next year, as long as you're holding onto that property for at least 5 years, you're going to do well. That's my opinion.
I would agree with that totally. I'd say that's one of the number one questions I've been getting is now the right time to buy? Am I getting in at the right time, or should I wait? Like, are the prices going to come down more? And a lot of people don't realize, like, to your point, that they've already come down quite a bit. Like, we've already seen the impact that I think the government wanted to see with these increases. Like, you got to admit, a lot of these increases are hard to stomach, but they are doing what they were intended to do. And real estate prices is one of them. And I would agree. Any time over the next 6 months is probably going to be the perfect window to buy.
You're waiting for the bottom, you're probably going to miss it because you're going to catch somebody on the way up. Some last foods for thought on that one right there before we push forward would be that there's some considerations that could push us back up earlier despite the rate increases. Obviously, if there is a pause in the BOC hiking, perhaps the fact that wages are increasing right now, we've seen wage growth by 5% in the last report, which is quite a bit, obviously. So when we see wage growth happen, people have more money to spend, despite the fact that qualifications are slightly reduced, right? Demand based on certain demographics, the first-time homebuyer segment is making up a larger percentage of people looking to buy. It's up apparently 0.5% versus last year, which is a lot of humans looking to buy homes. And those people, they weren't in the market a year ago or 2 years ago. They could look to buy. And then, of course, last but not least, low inventories. You just mentioned, Dean, that the construction jobs are down. People are putting a pause on building and development, which means in a few years from now, guess what? There aren't going to be as many buildings. So all these things together could push prices back up. We just don't know when. But like I said, if you're buying a house now, you're buying it for 20% off. If you said that a year ago you get a home for 20% off, you'd be a pretty darn happy camper. So don't wait too long on that piece. I don't think it doesn't make any sense to do so. So I think we don't know where the bottom is. We know now what qualifications look like. We know what impacts it. Some little tidbits here. If you are waiting for the government to come to your rescue, don't. OSFI has indicated they have zero. They're not going to loosen any guidelines or restrictions. We've talked about 30-year mortgages with less than 20% down before. We've talked about loosening the guidelines in less than 20% down situations. If you're a first-time buyer or a buyer with less than 20% down, don't expect the government to come to your rescue. And if you're excited about the potential of a new candidate for Conservatives, again, that's probably not going to help you for at least 3 or 4 more years if it even comes to fruition. So really, I think the biggest thing for a lot of our listeners and borrowers is to, again, as always, take care of your home, take care of your budget, take care of your personal situation, ride this out. And if you're looking to get into the market, remember, it's really up to you and not anyone else to get in. And now could be the perfect opportunity. I guess that's it for us today. Unless there's anything else that you guys wanted to point out at this time right now. Looks like we are past due for time, and we've got a lot of content on the radar. This was meant to be a quick hits episode, just keeping you guys up to date of the Bank of Canada, what's happening, who it impacts, and so much more. The next couple of weeks episodes, you are going to really want to tune in, and hopefully you can give us some feedback and honestly just a review on Spotify or iTunes. We would absolutely love that. We really appreciate it if you're loving the content, just so we know that you are. Again, stay tuned. Some great episodes. And if you want to find out more about working with the team here at Thrive, feel free to reach out at thrivemortgage.ca or find us on Instagram at Thrive Mortgage Co. We'll see you next time.